This is the Rocket City Retirement Show with Cris Wallace. Cris loves educating people in person and over the airwaves. Whether it's retirement planning, investing, tax, or legacy, Cris prides himself in helping protect what matters to you. This is the Rocket City Retirement Show.
Hi, I'm Luann Fulmer, and welcome to our show today. This is the Rocket City Retirement Show with my friend and certified financial planner, Cris Wallace. He's president at WG Financial Group, and also joining us from the firm, certified financial planner Richard Constantine and financial advisor Graham Bauer. So we have such a good show for you today. Let's get you this phone number so you can have it in your pocket, because it's how you can reach out to Cris for a complimentary visit. 256-937-2010. Now, here's the deal. You can call or even text that number. If you want to text the word visit. 256-937-2010. Get that complimentary discovery session. Remember to check us out on Facebook. Look for WG Financial Group 256. And our motto is plan, retire, and play. And that's what we want for every retiree out there that's listening, that comes in to WG Financial Group. You can find us online anytime at WGFinancialGroup.com. And remember, our show is available on Spotify and Apple Podcast, right? Anywhere that you get your podcast. Just listen to the Rocket City or search for the Rocket City Retirement Show. So, gosh, hello, everybody. So happy to be with you today, guys.
Yeah, great to be here with you as well, Luann.
Thank you.
It is, Luann. Always a pleasure hearing your voice.
Thank you.
Yes, it is. Hi, Luann.
Hi there. Okay, so we have a really good show that we're going to get into today, but I want to first start off with just what's going on with current market conditions, and maybe we'll get into some current events. But I guess I'll hand this to you, Richard. Let me have you answer about current market happenings.
Yeah, Luann, thank you. So far, the S&P 500 year-to-date has returned 15.10%. The Dow Jones has returned 3.90%. The NASDAQ is leading the charge at returning 17.20%. And the aggregate bond index is actually down 1.50%. This is actually the largest divergence between the NASDAQ and the Dow Jones since the 2008 financial crisis. You know, one thing that I do want to mention with that, though, is one of the main concerns back in 2008 was the amount of companies who were unprofitable. And what I mean by that is the companies who were contributing to a significant portion of the S&P 500, the NASDAQ, or the Dow, that actually were not, they're actually losing money. And so back in 2008, 28% of the large cap United States companies that were in the S&P 500 were actually losing money. Currently, it's only about 10% of large cap companies. So all that to say is the difference between the NASDAQ and the Dow Jones is quite significant. NASDAQ's up over 17%, like I mentioned, where the Dow is right at about 4%. But this is not a repeat, in our opinion, of 2008 due to the levels of profitability that we are currently seeing in our market leaders.
I think you've also got the tech stocks, that are in the NASDAQ. And if you look at the S&P, it's up significantly higher than the Dow as well. Probably got those magnificent 7, 8, 10, whatever they call them nowadays, pulling the way, right?
Yeah, the Mag 7 actually, the S&P 500's weighting is actually 35% of the whole S&P 500 is concentrated in those 7 stocks.
Wow.
With that being said, that's not historically too different than what we've seen. Cris, you and I covered that on our show about a month and a half ago. So,
All right. So anything else that we want to talk about right now? When this show airs, the debate will have just happened. That's something kind of going on everybody's talking about. So we'll be talking about that then the following week, just what comes of that. But here we are, well into the 2024 election, right?
Yeah, I mean, Luann, to your point, I mean, I think it'll be interesting to see if anyone brings up how the current tax laws are set to sunset in 2025.
Yeah, exactly.
It'll be interesting to see who is brave enough to bring that up in conversation.
I would guess that I don't think. Well, we'll see.
Yeah.
We'll see. I mean, honestly, because it was Trump's. It happened on his watch, so he might bring it up. Of course,
that's what I'm thinking.
Year to date, we haven't seen anything where any of the candidates previous to this debate, of course, where they brought it up, which was just shocking to me because I think that's what a lot of people end up. I think a lot of people care about that.
Mm-hmm. Exactly. I think we have Biden saying though that he's going to go ahead and let it expire, so it'll be interesting to see. But okay, so I want to make sure that you have this phone number. We're so happy to have you along with us today. You are listening to the Rocket City Retirement Show, and here's that phone number, 256-937-2010. That's how you can reach out to Chris and this awesome team that's before you here, Richard Constantine and Graham Bauer. They're all part of the awesome team at WG Financial Group, and they're here to guide you about retirement. So the other thing is check us out on our website is wgfinancialgroup.com. Great information there at your fingertips, and we are so happy to have you with us today. Thank you for spending part of your weekend with us. I'm Luann Fulmer. All right, so today we're going to actually go back into the world of taxes. Okay, we've been talking about that here in weeks past. The guys are going to even take a deeper dive into specific topics and even vehicles that can be used to help you save on your taxes in retirement. So let's get started. Chris, I know you wanted to start off with a couple of topics, so I think I'll hand this first question to you. You have been beating the Social Security drum for the past 8 years, on our airwaves. So I want you to walk us through an example, please, of how Social Security is more tax efficient or is a more tax efficient source of income, please.
Yeah, no problem. You're right. I've been banging the drum forever. A lot of people look at the break-even analysis, and there's just a lot more to Social Security than just looking at the break-even. So delaying Social Security leaves more room on your tax return for Roth conversions if you're looking to do that. Delaying Social Security also allows you to potentially spend some of that pre-tax money early in retirement so that when you get to your RMD age of 73, 75 years old, hopefully you're not having to pull as much out when it comes to RMDs. You'll likely leave less pre-tax money to the kids. So if you're spending it down or converting it, you'll leave less pre-tax to the kids, which can be a good thing. And let's go over an example. And I'm going to do my best to talk about numbers on the air. It's real hard to track, but there's some good information in here about the tax efficiency of Social Security. So like you mentioned, we're going to talk about taxes. Social Security is one of those vehicles I feel like we have to look at. So let's go over Johnny and Samantha example. And let's just say right now they're both age 62. They've recently retired. They need $70,000 of income per year to pay all of their expenses. So $70,000. They are going to claim early a Social Security with both of them. They're both going to claim early. And let's just assume their total is $35,000 per year in Social Security. Now that represents, if they claim at 62, those of you who've been listening to the show for a while know that there's a 30% reduction in benefits. So we're at $35,000 a year in Social Security. And, I said they need 70. So do the math. They have to pull $35,000 out of an IRA. If they do this, they are roughly going to owe, between federal and state tax here in Alabama, they're roughly going to owe somewhere in the neighborhood of $3,800. And if you're doing the math correctly, and you've got 35 and 35, which is 70 minus 3,800 in taxes, they're actually going to have to pull out more than $35,000 out of the IRA. But this is just an example to kind of give you a big picture idea. So again, to recap here, they claimed early. They've got a 30% reduction in benefit. And because of that, their Social Security benefits $35,000. They need 70. So they're going to pull $35,000 or slightly more out of an IRA, and they're going to owe somewhere in the neighborhood of $3,800 in taxes. So again, when we're talking about taxes, I always like to put the disclaimer: I'm not a CPA, but if you know how to read a tax return and you know how the tax return works, you can kind of look at this stuff and you can kind of figure it out to some degree. We would always say get numbers verified by your CPA. But again, in this example, I'm going to show you the power of kind of waiting on Social Security and the tax benefits of it. So let's use the same couple. Let's use Johnny and Samantha example again, but except this time they're going to wait until full retirement age. So their Social Security benefit at 67 now is $50,000, not 35, because at 35,000 at 62 they took a 30% haircut. So again, they still need 70,000. They've got $50,000 now of Social Security income coming in, and they pull money out of the IRA, say 20,000, because remember they need 70. 50 plus 20 equals 70, right? So that pays all of their benefits at that point. If they do this, and they do this at age 67, like I'm describing, there's zero federal and there's zero state in Alabama, because Alabama just passed a law where you can pull out of an IRA and you have a $12,000 relief. So if they use both of their IRAs to pull from and they have their Social Security, they're under the limit where their IRA is going to be taxed federally, just because once you put it on the tax return and factor in the standard deduction, it's pretty much going to give them a window of money that they can pull out. So $50,000 plus $20,000 pull will result in no federal and no state tax. Now, again, remember, these are examples. I'm not giving advice here on the air, but this is really, I'm going over this to kind of provoke like thought in your head on like how you should look at Social Security versus the break even. Because many of the listeners out there today are cranking out the spreadsheets. They're looking at the break even, and this is how we look at it. Like we're looking at the taxable income. We're looking at many, many different things when it comes to Social Security. So the first thing to remember is Social Security is more tax efficient. So when you're making the decision on Social Security, let's go at it, from a tax perspective first. Let's also look at it from a spousal protection standpoint. So if we collect early, we are penalizing our spouse, especially if he or she is the lower income earner. So more tax efficient, spousal protection, and then you're going to have more money for longer, because many of us are going to live a longer than average life expectancy, despite what I hear in the office all the time, which is, I'm not going to make it to 75, Chris. I don't know why you're running my plan to 92. Many of us, regardless of what you think, are going to live a longer than average life expectancy. Now, with all that said, and even in the example I just gave, there are times that we need to deviate away from this, and this is why we run the analysis for each and every client, so we can determine what's the best optimal strategy for your family, not only from an income perspective, but from a tax perspective.
I want to jump back really quick to one thing specifically you said when you were talking about, Social Security and the amount that they could pull without any federal taxation. I'm actually going to give this example because I have seen this, I think just one time, because it's a bit of a specific example. But, for some people, that $20,000, if you have, maybe less than $500,000 of pre-tax saved, that could be your RMD too, that you're pulling, that it's sort of satisfying for as well. So I think it's, a really good thing to think about. And it kind of blows people's minds sometimes when we bring it up. And obviously, there's no guarantee that it will be possible at the same level forever as tax brackets and tax codes and standard deductions and all of that change. But for today, it's a huge advantage. And for some people, they might be paying way less taxes than they assumed they would.
Yeah, it also opens up an avenue for Roth converting. So let's just say that, for example, because a lot of people that are debt free, they're living on pretty basic income, like $50,000 for a debt-free family that doesn't travel and doesn't eat out a lot. They can live on $50,000 here in the state of Alabama. So if you didn't need that extra 20, that's like a free Roth conversion at that point. And I know we have people internally that we've worked on and we've done that for. And I told one couple that you have this ability to do this. You have this window, this magic window where you can convert. I think, Graham, they're one of your clients that you serve. I think they did it again last year, right? Because they have the window, correct?
Yep. And every year, what she said so far to me too is, are you sure this is going to work again? And it's like, well, it's been working.
It's been working.
We run the numbers, wait until the end of the year, because it is fairly sensitive, as when you're doing the numbers like that. We want to be conservative because you get the interest you get on your bank account, random things like that sort of vary, which can affect it, the Social Security, COLA, and just different things like that. But yeah, it's been going for a couple years now, and we're probably about to do it again here in a couple months.
There are people out there listening to the show right now that have this opportunity. I have a prospect that I'm working with. They're not yet a client, and they were asking questions very similar to what we're discussing here about their mom. And they asked me, they said, I know there's an amount. They at least knew a little bit about this, and they don't listen to my show. They will in the future, I hope. But they know there was a specific amount that they could pull out without getting taxed. So they asked me in the meeting, they said, I know there's an amount we can pull out. Can you help us determine what that amount is that we can pull out? And I looked at them and I said, well, why would we want to pull it out? Because why wouldn't we want to Roth convert it? Because if we can Roth convert it for free, then there's never going to be tax on that money. If you pull it out, and you didn't pay taxes of it on the pullout, but then you put it in the bank account nowadays, making anywhere from say 2.5% to 5%, depending on where you're at on the money market or high yield savings. Now you're going to turn around and pay interest income tax. You're going to pay tax on that interest that they give you. So why not just convert it and put it in a Roth? And then also from an inheritance standpoint, you're inheriting Roth money, not just ordinary income money. So anyway, there's a lot that can go on with these decisions. And I think that's what makes us valuable is we're always looking at those things from a tax perspective.
So I want to ask you another question. This past one had to do with people claiming Social Security, ending work and then claiming early at 62. What about this? Let's say I'm 62, I'm still working. Should I claim Social Security? And if I do, then what are those potential tax drawbacks?
Yeah. Good question here, because there's a lot of people that are working and they want to claim. So just understand, and the limit today in 2024, if you make more than $22,320 or $1,860 a month, Social Security is going to deduct $1 for every $2 after that limit. Now, the thing to keep in mind here is they look at gross income, because I had somebody in the conference room the other day talking to me about this very same subject, and they were, hey, we itemized this. They were self-employed. We itemized this and itemized that. Social Security looks at your gross income. They look at your gross income, and that's how they determine it. In the year that you turn your full retirement age, it drops to $1 for every $3, and that earnings limit jumps up to $59,520. Now, they only look at job income. So like W-2 income, like pensions, annuities, investment income, interest, money like that is not counted towards that number of $22,320 or $59,520. Now, you may be thinking this is a tax. It's really not a tax. What they do is they just withhold it. And you're thinking, well, if they withhold it, do I ever get it back? And you actually do. When you hit your full retirement age, if you've claimed early, and you're making over the limit and you're getting money withheld, when you hit your full retirement age, what they do is they recalculate your benefit at that point, and they essentially get it back to you or give it back to you. So we can make a kind of an example here. Let's just say they withheld the equivalent of 10 months worth of benefit. Then once they recalculated your payment, your new Social Security benefit will be reflective of like a 26% reduction versus that 30% reduction for claiming at 62. Now, that is if you're claiming at 62 and you're still working. Yeah. Now, I want to jump to another story real quick. It's story time, kids. Gather around.
Love it.
All right. So I ran into a couple a few weeks ago. I've actually seen this multiple times, but more recently, and I thought, you know what, I'll just take this story to the air because, if I'm seeing it in the office, then there's no doubt in my mind that it's happening out there, in the listener world, if you will. So, okay, this couple came in and they decided that they wanted to just claim the wife's benefit because they could. The husband is still working. He's still working and he's making a good salary. And they just decided, hey, you know what? My husband, or it's my benefit, I'm going to go ahead and collect. That gives her a little bit of extra money. He's making about $190,000 a year. So they went in and started claiming at 62. So here's the problems. Number one, if we claim at 62, then we know, again, I'm going to repeat it again, it's a 30% reduction in benefit if your FRA is full retirement age is 67. Number two is it stops the growth. So we know if it's a permanent reduction of 30% in benefit, then what happens is you also are stopping that growth, which is about 6% a year. It's a little less than that, but let's just round it and call it 6% a year. Number three, it adds to the taxable income, which in their case would increase their taxes by about $1,600 more per year. And this is, again, a rough figure. So we've reduced our benefit, we've stopped our growth, Now we've added to our taxable income, which makes the net effect of that Social Security amount a lot less. And then the other thing that they told me was, it's just a small amount, Chris. She's going to get half of mine anyway. And I'm sitting there thinking, no, they're not. Let me explain that to you as well. So not only we stopped the growth, we've added to our taxable income. She's not going to get half because she claimed early. So here's the math behind that. Let's just say, for example, his primary insurance amount or his FRA amount was $3,000. And let's just say that hers was $1,000. So she claimed at 62. So she's now drawing 700, and that's adding to the taxable income that we talked about. When she goes to file for spousal, because now now that she's filed at 62, when he files, she's got to actually go file again for that extra spousal. When she files, she's only going to get $500. And you figure that by taking half of the higher income earner's PIA amount, subtracting her PIA, which is $1,000. So 1,500 minus 1,000 leaves you with 500. She claimed at 62, she was getting 700. So you take 700 plus 500 and she's going to get 1,200. So she didn't get half because remember his PIA was 3,000, half is 1,500, but because she claimed early, she's only going to get 1,200. So this whole understanding of quote unquote the half rule and how taxes work on Social Security and how it impacts their entire situation, they were totally confused, and I would say really not informed on it. So when I walked them through this, I went over to the other side of the table and I picked the husband's jaw off the table. I picked the wife's jaw off the table, put their faces back together because they couldn't believe it. They were very shocked. They were like, I thought, and I was like, yeah, I know. I have other advisor friends who thought this as well. And I walked through this example and they get it. And now they're serving their clients in a better capacity as well. So
yeah, that half rule, I think, or half of your spouse's, your spousal income rule for Social Security is really misunderstood, and did a good job explaining it there. One other thing I think to note, too, is that it changes even more if both people collect early. So, I mean, in that example, he collected at full retirement age.
Right.
So in that example, she was going to get half of his $3,000 primary insurance amount if she also collected at full retirement age. But, if he collected at 65, 64, 63, then that's going to lower the spousal she gets as well as her own too. So really the half rule only works if you both collect at your full retirement age. It's not just half no matter what. It's a much more complicated equation than that I don't think people really realize.
Yeah, and it's so a really good point you brought up there, Grant. It's half of the full retirement age amount. So you don't get half if you wait till 70. So I've had husbands tell me, hey, I'm going to wait till 70 because my wife gets half of the 70. No, it's half of the FRA amount, which is, let's just use 67 in this case. So, and it's not half if you collect at 62. It's half if it's FRA for both of you. That's how you get the half. So again, the rule is very, very, very misunderstood.
Right. Real quick, I want to get that phone number out again, 256-937-2010. If you have any questions about what we're discussing today, if you have your own questions about Social Security, reach out to Chris because going in and seeing him is complimentary, all right? You may call 256-937-2010 or text the word visit to 256-937-2010. And again, you can always find us on Facebook. Just search for WG Financial Group 256. And we thank you so much for joining us. This is the Rocket City Retirement Show. I'm Luann Fulmer here with Cris Wallace, WG Financial Group. He's president. Of course, we also have Richard Constantine and Graham Bauer here. So I have another question here for you, Chris, about taxes. There's a favorable piece of the tax code, and it's called the net unrealized appreciation. So I wonder if you could explain this NUA, what it is, how it can be potentially beneficial for individuals who could use this in a unique way.
Yeah, so it is so this is probably I would say it's probably the second best thing in the tax code behind HSAs. HSA, most of us can have an opportunity to do that. Not all of us are going to have NUA or net unrealized appreciation. What this is and what it means is some 401ks you're allowed to buy your company stock in. So there's some big companies here, in Huntsville, Boeing, for example. you can have, your company stock inside of your 401k. So what happens is it creates an opportunity for NUA, and you have to have the company stock in the plan to be able to do this. And what you can essentially do is at retirement or separation, you can actually roll that stock out to a non-qualified account. So it doesn't necessarily have to go to the IRA, because, most people, when they retire, they're going to roll their 401k most of the time to an IRA. And if you have that company stock in the 401k, you can actually roll that out to a non-qualified account, a non-IRA account. Now, there's a couple of things you're looking for here. So you do have to have one of these qualifying events to make this happen. Retirement's one of those. The account has to be emptied out completely by the end of the year. And what you're looking for is about a 30 to 35% basis number. So what do I mean when I say that? So let's just say the stock price is the stock value is $300,000 of all the stock you have in their company stock wise, and the basis on that $300,000 is $100. Well, that's 30% of $300,000. So you've got $100,000 in basis. It's 30% of $300,000. In our opinion, it kind of would make sense to do what we call an NUA rollover. Now, when you go to do that, what happens is you will pay taxes on the basis in that tax year. So let's say, for an example, we have this situation where we've got shares of stock valued at $300,000 today. The basis in those shares of stocks is $100,000. That can be rolled out in UA. The person that did that, they're going to get taxed on $100,000 today, ordinary income tax. What makes this really attractive is moving forward, those shares are now in a non-IRA account, and they now are going to fall under the capital gains rules and no longer are subject to RMDs in the future. A couple of things to note here on this type of account. It is or this type of rollover, it's very specific. It can't be messed up and it cannot be undone. So when it's being done, it must be done correctly, and all the proper steps need to be taken to make sure that it's done correctly.
Okay. So another question would be, typically people pass away with maybe securities in a non-qualified account, like a non-IRA account, and those securities are then, inherited at a stepped up basis. So is that going to still happen if you do a NUA rollover?
No, actually, with NUA rollover, I know exactly what you're talking about. In most non-qualified accounts, non-IRA accounts, if somebody passes away, the beneficiaries get it stepped up. Not with NUA. Once you do NUA, you lose the step up. So that's one of the disadvantages to NUA when it comes to inheritance, for sure.
Okay.
One more.
Yeah, go ahead.
Sorry, one more thing I wanted to add about NUA really quick is some people. This is one thing I think some people might not know. You are not able to spread it into multiple tax years as well. So I believe that if it's in a qualified plan, which it has to be for NUA, you're going to have to empty out the whole plan in one tax year. So
that's right.
You're going to have to pay all those taxes in 1 year. So it can be a bit of a drawback for people. But overall, Chris, yeah, it's a huge benefit.
Chris, I guess by listening to you, then, someone could have a lot of exposure in one company. What are some options to consider?
Yeah, they can. So doing an NUA rollover, sometimes, years and years ago, the company would allow you to put in tons and tons into a specific position. And when you do this, it does create some potential to have overexposure. So number one, you want to start diversifying. You could donate to a donor advised fund. You could also set up a charitable remainder trust for income. And those types of ways will help you diversify and get rid of some of that tax exposure, especially when trying to unwind some of that NUA rollover exposure. So it's been a great half of the show so far. If you're listening right now and this is the first half of the show, you can hop out to Apple Podcast, Spotify, and you can catch the entire episode right there. Again, that's just by searching Rocket City Retirement Show on the Apple Podcast or Spotify platforms.
Want to feel confident in your financial future? Let Cris Wallace from WG Financial be your guide. Take the first step today by visiting WGFinancialGroup.com.
Quarters, just 25 cents. That's hardly anything, right? But Cris Wallace and his team at WG Financial see quarters a little differently. A quarter is a lot when it's a quarter of your retirement savings. Now, do you want to pay 25% or more in taxes during your retirement? Well, Cris can create a plan to help address that. Now, if the only time you think about taxes is when you file them, you don't have a tax strategy. But it's not too late to get one with the help from Cris Wallace. So act now to make sure you're not paying a quarter, dime, or even a penny more than you should. Call Cris Wallace and his team at WG Financial at 256-937-2010 to schedule your personalized tax strategy session. A quarter saved is a quarter earned. Call 256-937-2010 now. That's 256-937-2010. Investment advisory services made available through AE Wealth Management, LLC, a registered investment advisor. Firm may not give tax advice.
Don't panic in uncertain market times. Let Cris Wallace be your trusted guide. Call Cris Wallace today at 256-937-2010 for expert advice and support. That's 256-937-2010.
We thank you so much for joining us. This is the Rocket City Retirement Show. I'm Lou Ann Fulmer, here with certified financial planner Cris Wallace, also Richard Constantine, certified financial planner and a financial advisor, Graham Bauer, all of WG Financial Group. So we're all here, and I get to ask them questions. Hopefully they're similar questions that you, our listeners, have, and we're so excited to have you along today. Thank you for spending part of your day with us. So, all right, you guys were mentioning a CRT, or a charitable remainder trust. In what ways do they help provide to those who are charitably inclined? Why don't you explain that, please, Cris?
Yeah. So CRT, charitable remainder trust. First of all, you need to have charitable intent. That is really the design by one of these vehicles. They're incredibly complicated, and you should work with an attorney who is really familiar with setting these up. In other words, don't just go to your random attorney and say, hey, can you set up a CRT? And they're likely to say, oh, yeah, I can. It's just some paperwork and all that. It's our recommendation that you work with someone who is very familiar with how they are taxed, and understanding how to set them up, and that they've done multiple ones. It would be our recommendation. There is a cost to set them up. The cost can be, with the tax deduction that you get from it, more than likely will be, overcome substantially, the setup cost there. And then also just be aware that ongoing, there are some administrative costs. So every year there's going to be some cost to, keep the trust intact and, figure the distributions and all of that. 10% of a charitable remainder trust, 10% minimum, has to go to charity. So that's why it's called charitable remainder. So the remainder percentage, 10%, has to go to a charity. You can have fixed, payments coming out of the trust, or you can have kind of variable. And if you have fixed payments, it's called a CRAT, a charitable remainder annuity trust. If the percentages are variable based on the balance, that's a CRUT. That's a charitable remainder uni trust. And so you have two different ones, and there's, you can dive even deeper than that. So we're going to keep a little bit high level today on these types of vehicles. When do they make sense, in my opinion? So when do they make sense? So, wow, Cris, I've never heard of this before. Yep. They're not for everybody. They make sense when you have a highly appreciated asset. Like for example, if you have a heavy concentration in stock. So let's go back to this NUA rollover thing that we were talking about a little bit earlier. And let's just say that you rolled over, I don't know, let's just call it like $700,000 of a specific stock, XYZ, let's call it. And so what you can do is you can really donate that stock to the charity, or to the trust, the charitable remainder trust. And the stock inside of that trust can be sold and at no taxes. And then you could have distributions taken from the trust. And if it's stock and you wait more than 1 year, the tax out of the trust will be at, long-term capital gains. But you can essentially start diversifying that heavy concentration of stock, a little bit quicker. The other reason to use it is if you need income. So charitably inclined, maybe a highly appreciated asset, and you want to take income and really want the tax deduction to go along with it. So again, the trust can sell it with no tax liability. So how much of a deduction do you get? It's basically like 10% of the value that's contributed. And so that's basically kind of the tax deduction amount that you can take is about 10% of what you put in there. Another way to use them is actually post-death. So this is a really good way for a lot of people with large IRAs, and their kids are beneficiaries, and the kids are going to inherit large IRAs. And by the Secure Act, they took away the stretch IRA. And so now you have to have all of the IRA money, taken out and paid the taxes on by the end of the 10th year. So we all know that's in place. But if you use a CRT appropriately, you can actually put IRA money in there and you can actually stretch it out over 20 years.
Ooh,
Again, you need to have charitable intent, and you need to have your legal documents addressing this. And again, we highly recommend working with someone that understands the languaging, understands how it has to be in there. But this is a great way to give to charity because, again, it's a charitable remainder trust, so 10% remainder has to go to charity. But it also allows the money to kind of be stretched out over 20 years versus 10, which will probably lessen the tax burden of the beneficiary. So a very interesting vehicle, again, not one that's known a lot about, but it's worth considering. We've seen a couple of instances where we think they can be beneficial, but it's really more about, I guess when I bring this stuff up, it's about the depth of knowledge that we have at the firm and really understanding how we're looking at all different types of vehicles. Because again, some of you listening to the show today, it's going to be one of your first times hearing about this vehicle. And it is an opportunity for, families, individuals. Sometimes it's even an opportunity for business owners. There are ways, to put part of the business or all the business into a CRT and do some tax planning that way as well.
Wow. Great information here. See, you get wisdom, you get the knowledge from Cris and his team here at WG Financial Group. They do this every day. A charitable remainder trust. Oh my gosh, a way to possibly stretch out any IRA money that you inherit. So cool, Cris. Didn't know about that. So thank you for that. And we thank you so much for joining us. This is the Rocket City Retirement Show. I'm Lou Ann Fulmer, and it just brings another question to mind. Would you do this with any Roth money, or could you?
Really, really, really good question, Lou. Actually, I know in our show notes, I actually forgot that question was on there. So really good reminder question for me as well. I would not. And why do I say that? Well, since the trust doesn't pay taxes and the charity that's receiving the remainder doesn't pay taxes, I'm not sure that I would do Roth money. So if it were Cris, I would not put Roth money in there. I would use that as a vehicle for IRA money because, again, the 10% remainder going to the charity's not going to pay the tax on it. I would probably do something different with my Roth IRA money, but excellent question.
Okay. Yeah. All right. So now, Richard, you have some questions that you were going to bring up still on the whole tax topic here. So I want to kind of tee you up here and let you kind of take it from here. Okay.
Yeah, no, that sounds good. Sounds good. Yeah, so Lou Ann, a common theme that we've been seeing recently is potential clients come in the office saying that they want to live off of dividends only. And, that is, it seems to be a goal for a lot of people. And, there are some misconceptions along with that. The first part about living off of dividends alone is there are two different types of dividends. So, the first off is a qualified dividend, which is what 90% of people will receive. If Apple pays out their quarterly dividend, it's going to fall under the qualified bucket. If you're invested in an S&P 500 tracker, it's going to pay off a qualified dividend. There are also non-qualified dividends, which are generated from ETFs that are doing covered call sales and a few other really more complex things. And so those are actually taxed at your ordinary income rate. So there's two different strategies there. The non-qualified dividends are going to pay off more in income, but they're going to be taxed less favorably.
Yeah, I think also I just want to bring this up because you were talking about, we've heard it. I've seen and heard it a lot too throughout my career. The problem with that is when we talk about dividends and the taxation of dividends, if it's in an IRA, it don't matter. Like the qualified, it's out the window at that point. It's all taxed as ordinary income. So I've had that question before from people that have come in the office and their thought is, hey, I just want to take the dividends out because it's taxed differently. Nope. If it's in an IRA, it's taxed
Exactly.
as ordinary income for sure.
Oh, exactly. Well, too, and Chris, dividends aren't just free money, right? If Apple is trading at $100 a share, they're going to pay out $1 quarterly dividend. The stock price is actually going to go back to $99. It's not, they're not just giving you away free money.
No.
So with the dividend in play, all it's doing is it's requiring a mandatory distribution at the time the company says it's going to be sent out. We feel that, taking a percent out of your portfolio on a monthly basis, whatever you need, is a more effective strategy than trying to live solely off of the dividends.
Yeah, I think what you're saying is we feel like most stocks will outgrow the capital appreciation plus dividend with dividend paying stocks for the most part.
Oh, exactly. I mean, the reason why the company has dividends to pay out is because the company has excess cash. And the only reason why they have excess cash is because they don't see any research and development or new market expansion activities that are worth their time or energy. So the company is no longer trying to grow. They don't think that it can grow significantly. So that's why they have the excess cash to pay out.
Oh my gosh. Okay.
So, I mean, dividends are not bad inherently, but there are better ways to get the amount of money that you want to live off of.
Right.
So how about this then? Should you tax loss harvest every year, Richard?
The answer to that is yes, Luann. So tax loss harvesting you can do inside of a non-qualified account. So a brokerage, either a joint account or an individual account. So back when mutual funds dominated what people invested in, the tax loss harvesting rules were very clear that you had to move your money from the XYZ S&P 500 index to a completely different index. Well, now that ETFs have taken over the marketplace, essentially, the rules about tax loss harvesting, they've gotten a little bit more gray. So you're actually able to go from the Vanguard S&P 500 index to the Fidelity S&P 500 index. And that actually will count as being able to use the tax loss harvesting rules. And why that is important is, let's say back in 2022, when the S&P 500 was down roughly 20%. So in that year, let's say you started with $100,000, your position went down 20%. At the end of 2022, you actually only had $80,000 in the account for a loss of $20,000. Well, what if you had just sold the position then, put it inside of a different company's S&P 500 ETF, you would have been able to write off $3,000 worth of ordinary income from your real job, or if you were still working from your job, or if you're retired, you're still able to write off $3,000 from any other distributions and whatnot. But what it does is it also allows you to bank or to save that $17,000 difference in the tax that you wrote off, essentially, for future growth in the future. So then the capital gains on that position are going to be wiped away in the future too.
Yeah, so you can carry it forward, right? And there's no end date. So I've seen accounts. Oh my gosh, I've seen accounts where they've come in and like tens of thousands of dollars.
Oh well, Chris, we have a new client who has over 800,000 in carry forward loss. He was an employee in a small phone company who went bankrupt, and so we are working on that loss right there.
Yeah, so I think in this case he's going to be carrying that forward to the grave.
Beyond the grave, probably.
Yeah,
Someone's got to find him the fountain of youth so he can use all that loss.
We won't be able to. Well, I mean, yeah, just take a miracle to get all that offset. But yeah, that's the cool. So tax loss harvesting is an excellent tool inside of a non-qualified account. You should be, but I think some people have a problem with it, right? Because they love a stock so much that sometimes it's good to sell a stock or a portion of it at a loss, because it helps on taxes. And we believe that should be looked at for sure every year with every person that has a non-qualified account.
Well, and Chris, too, like to your point, right? Some of our clients have NVIDIA in their portfolio. NVIDIA is up significant amounts, but if the client almost feels that they want to not become so concentrated in that position, well, if they have a loss that they carried forward from previous years, we can actually sell part of their NVIDIA or another appreciated position and essentially cancel out that growth. Or that capital gain that they otherwise would have had to pay taxes on. So it is incredibly important to stay on top of the tax loss harvesting potential that you can do each year.
Yeah, and I think ultimately, sorry to interrupt you, Lee, and I apologize. I think it's important to look at that every year because I think the goal in a non-qualified account is to try your best to get as much of the gains harvested out of there in the most tax efficient manner so that you don't, you're almost at a zero basis, not zero basis, but there's almost no gains in the account. And you can, over time, you can harvest a lot of that out of there by doing tax loss harvesting over a period of time.
Exactly. Yep.
All right. So, we've talked a lot about taxes and we always discuss Medicare on our show. What happens? I want to go to this question. Chris talks about this a lot. What happens when you go through IRMA?
It's a great question, Luann. And so, one of the ways that you can go through IRMA is if you take a larger distribution out of your IRA than you typically do. So currently the IRMA limits for a married filing jointly tax filer is $206,000 this year. That includes any sources of income. What happens is if you go over that $206,000 limit, you're actually going to have an increase in your Medicare Part B. And so the first part of that is it's going to last 2 years, and you're subject to the increased cost, which then just add a higher tax bill, which then means most likely you're going to have to withdraw even more funds out of your IRA to catch up. And so it kind of creates a snowball effect that can be incredibly suboptimal.
Right.
Yeah, I think also just to talk a little bit more about IRMA here, there's different levels of IRMA. So, Richard, you mentioned the 206 IRMA. That's the first bracket. So that's for a married couple is 206 to 258. So if you're a single filer out there, I don't want you to feel left out. You just divide in half. That's all you're going to do. So 206 to 258 is the first IRMA level, and what happens is your Medicare premium today is $174. Medicare Part B premium is $174.70. And what happens is it goes to $244.60. And as Richard said, it stays elevated there for 2 years. So they always look back 2 years and they'll keep it elevated until then. And if you go through it's the next few levels that become very, very painful. So after the 258 upper threshold of the first level, it's the next level is 258 to 322. And at that point, your Medicare premium is $349.40, but it also impacts your Part D prescription plan. So now you're going to have a minimal payment at that point of $33.30 on top of the $349.40 for IRMA. Now, here's the thing. I've had a lot of people come in the office, and real estate's kind of gone crazy here lately. And they say, oh, wow, I sold property and now I'm paying these crazy IRMA limits. And unfortunately, that's the way that it works. So Richard talked about taking out of an IRA. It also falls for other pieces of, income that go on the tax return. So selling a piece of property, maybe you had $300,000 or $200,000 in capital gains. That's on your return. It's going to bust you through the IRMA limits, and there's nothing you can do about it. When you can do something about it is when you are working. So let's just say that you're working and then you retire and you get your little thing in the mail from Medicare. It says, oh, your Part B is going to be, $174.10. And then a few weeks later, they're like, just kidding. You're actually going to pay $244. Well, what you can do is you can file what's called Form SSA 44. And what SSA 44 allows you to do is it allows you to basically ask for Medicare to reduce those premiums based on what they call a life-changing event. It'll be in step 1 on the form. And those life-changing events are marriage, divorce, work reduction, death of a spouse, loss of income, producing property, loss of pension income, employer's settlement payment, or work stoppage. Work stoppage is a fancy word for retirement. So if you were working and all of a sudden now you've got this thing in the mail that says, oh, your premium's going to be higher, you can do SSA 44. I actually ran into this a few weeks ago with someone who came in my office. I actually believe that he became a client because I showed him this. And that's my speculation. I'm sure that he thought I was a great guy and, all of that fun stuff too. But at the end of the day, he told me, man, these Medicare premiums are killing me. And I was like, why? You just retired. How are you paying increased premiums? Like, oh yeah, it's increased. And he showed me stuff. I said, what? Here, SSA 44, let me print it and help you fill it out so you can turn it in. And sure enough, he got his premiums reduced.
Oh my gosh, that's excellent.
Yeah, and he's a client now because, again, just you come in, like we know these things in retirement. So
and we don't.
No, you don't. And
Yeah.
and you can Google yourself to death. You can Google yourself all the way through retirement. But at the end of the day, I mean, it's just kind of helpful, I think, to have somebody with a set of eyes that can really help you look at these type things and just help you walk through it.
And that's why Cris and Graham and Richard are here today to talk to you and explain these things to you. But you know what? You can go in even deeper in a personalized conversation by just calling 256-937-2010. Ask for that discovery visit. It's complimentary. All right. It's complimentary to go in and talk to them. 256-937-2010. If you like to text, just text the word visit. It's that simple to that phone number. But they would love to help you out with any questions that you might have. And they'd love to take you through the Rite Retirement process. Again, complimentary. So check them out at wgfinancialgroup.com. And the other thing we want to always remind you is that we're on Facebook, and anything that happens throughout the week, Cris will update things and put things on at WG Financial Group 256. So thank you so much for joining us. You're listening to the Rocket City Retirement Show. I'm Lou Ann Fulmer. So I want to talk about kids and grandkids for a second as you're talking about, the Roth. Can grandparents contribute to your minor children's, or even parents, to your minor children's Roth IRA?
So they cannot if the child or grandchild does not have any earned income.
Oh.
With that being said, though, the earned income rules are a little bit, they're a little bit, questionable. It stated that as long as they have earned income, even through mowing the yard or babysitting, that it can be applicable.
Oh, seriously?
Yeah. So kind of gray a little bit there. But here's what I would say. All that's accurate. Everything you just said is accurate. But I think if you're dealing with the IRS, you're going to want to document the heck out of it, right? So if someone's cutting grass, getting paid in cash, and then contributing to an IRA, in my opinion, you should have really solid records on that in the event you were to get audited. Okay. Now, what are the chances of an audit for something like that? I don't know. I don't have any idea, but I know that if you were audited and you can't prove it, then you're going to be in trouble.
Right.
And,
right.
So definitely just make sure you keep really solid records of that. I've heard I've seen stuff on TikTok, put your kids on your website as a model. My daughter was my daughter was underage and she'd never been on my website as a model. She's worked and contributed to her own IRA. But again, if you're doing that kind of, I'm not going to call it shady stuff. I'll just say more gray stuff. You just want to make sure you document the heck out of it as well.
Very
for sure.
Good. Very good.
Mm-hmm.
Okay, so I want to go the other direction now to retirees that have to pull out those required minimum distributions. What happens if you don't take an RMD from your IRA or another IRA?
The beneficiary IRA, is that what you're referring to, Lynn?
Yeah.
Okay, perfect. Yeah, so when we actually saw this recently, one of our clients had inherited a beneficiary IRA it was her mom's IRA. When her mom passed away, it became a beneficiary IRA for her. Well, she did not know that she had to take out distributions. And it's the same rule for both a beneficiary IRA or a traditional IRA. So before Secure Act 2.0, which came into effect a few years ago, it was actually a 50% penalty on every dollar that you did not withdraw from your account. What that means is if you were supposed to take out $10,000 via RMDs, you would have to pay a 50% penalty, so $5,000 if you do not take that distribution in that year.
Good grief.
It was extreme.
Yeah.
So they've actually lowered it down to 25%, and you can actually even get it lowered even further to 10% if you fix the problem within a 2-year window.
Mm-hmm.
Good. Okay. Well, it's better.
I ran into it as well. I want to say it was maybe a year ago. Money came over from a large firm, and in meeting with the client, I said, "Okay, you got to take money out of this thing. When do you want it?" And they were like, "No, I didn't know that." I was like, "What? This is after the Secure Act." And I said, "Hey, when's the date of death?" And they told me, and I said, "I'm sorry, this is pre-Secure Act. Pardon me." Mm-hmm. And I told them what's the date of death. They said, "Oh, it's 18. I said, you should have been taking, money out. This is in 23. And there was 1 year during COVID, you got the relief rule. Mm-hmm. But so what we did was we just went back and fixed it. And of course, again, this is just things that people, they don't know. Things happen. People pass away. There's rules involved. And Richard, I think, if I'm not mistaken, I think it was this year that they lowered that penalty, right? It was 50%, but this year they did end up lowering it.
Yes, it was recently.
Yeah. And here's the other thing too, just to think about. So when you have to pull these required minimums, whether it's from your own IRA or whether it's your beneficiary IRA, or better known as a inherited IRA, you can also do a QCD from either one of those as well. So we're talking about taxes on the show, and what's a great way to lower taxes. You can do a qualified charitable distribution. Again, you must be 70 and a half to be able to do those, but you can QCD out, and that will actually offset some of the taxes. So again, just to talk about how a qualified charitable distribution works, because here again, another client story. Clients working with another firm in the area. Number one, Graham, you brought up several weeks ago that if there's more than a 10-year age difference, you have to use the joint life, RMD table. And so basically this firm was using the wrong table. So this client was pulling out more than they had to, because on that joint life table, you get a little bit of relief. And then also they are charitable. There's actually 3 problems here. The second one is they are charitable and they were not told and were not using the QCD provision, so in the tax code. And then secondly, they were taking income out of an annuity, and they were taking income out of the annuity and still taking more out of their other accounts when they didn't have to. So there's like this 3-pronged problem that I ran into. And again, this is with a local firm, again, not pitching rocks here, but again, just kind of what I would call sloppy financial planning. And so when I uncovered this, I was able just to see it visually and know there was a problem, because I've been doing this for a while. So I was able to just look at it and go, there's a problem here. I recognize it. Things just don't look right. Things look, more than they should. Let me dig into it. And that's what I found out. But you can qualify charitable distribution from IRAs and inherited IRAs, and that can help once you're 70 and a half. So, Luann, it's been a great show. A lot of tax stuff again. I hope everybody's enjoyed it. Graham, Richard, always appreciate you guys being here. If you'd like to set up a discovery session so we can comb through everything that you have financially and make sure that your family is on pace for what you hope to be a good retirement. We want to make sure financially we're building that out for you so that you can go out and play, as we like to say. If you'd like to set up a discovery session, you can do that by calling 256-937-2010. Again, the number is 256-937-2010. I hope everybody has an awesome and blessed week, and remember to serve every person in every situation with a servant heart.
A Roth conversion is a taxable event and may have several tax-related consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.
Investment advisory products and services made available through AE Wealth Management, LLC, a registered investment advisor. Insurance products are offered through the insurance business WG Insurance Services. WG Financial Group is an investment advisory practice that offers products and services through AE Wealth Management, LLC, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by WG Insurance Services are not subject to investment advisor requirements. AEWM and WG Insurance Services are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. WG Financial Group is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by WG Financial Group. This radio show is a paid placement.